The solo S-Corp owner who never set up payroll is the single most common compliance gap in the small coaching practice, and the cost of fixing it retroactively at year end runs an order of magnitude above the cost of doing it right at the front of the year. Module 11 set the reasonable salary math. Unit 12.8 executes it through actual payroll. The mechanics are not hard. The discipline of getting the payroll service onboarded before the first distribution payment is what makes the Module 11 math become real dollars in the bank, rather than retroactive trouble at the year-end accounting appointment. If you elected S-Corp, you're an employer, and your only employee is you. That carries the same legal and tax filing obligation as any other employer, and the obligation does not soften because the employer and the employee share an address. Failing to set up payroll for yourself is the most common S-Corp compliance failure coaches make after the election. The fix at year end is messier and more expensive than the setup at the front of the year by a wide margin. The decision in front of you, if S-Corp is elected and payroll is not running yet, is to onboard a service this week, not to wait until Q4 or until the accountant asks at the year-end review. The S-Corp election from Module 4.10 turned your entity into a separate taxpayer, and the structure requires that you take reasonable compensation through W-2 wages rather than just distributions. The distribution beyond the salary portion is what saves the self-employment tax. That is where the S-Corp savings come from. The salary portion is what makes the structure legal. Without payroll running, the IRS recharacterizes all the money you took out as wages, runs all of it through SE tax, and the savings disappear retroactively. The payroll obligation is not optional bookkeeping. It is what makes the Module 11 election produce actual tax savings rather than retroactive trouble. Solo S-Corp Payroll has the same mechanical structure as any other payroll, with you sitting in both the employer seat and the employee seat. Form 941 quarterly, where the wages reported are your own reasonable salary. W-2 issued to yourself in January, covering the salary portion only. Distributions taken separately, not through payroll, not subject to FICA, and reported on Schedule E from the K-1 the S-Corp produces. The W-2 lands on your personal Form 1040 as wage income. The K-1 distributions land on Schedule E. FICA splits across two rolls: 7.65% employee share withheld from your paycheck, 7.65% employer share paid by the S-Corp. Deposit frequency for federal payroll taxes follows the same rules as any employer, and most solo S-Corp owners fall into the monthly deposit schedule by default. The IRS sets the deposit cadence based on the total federal payroll tax liability, FICA plus federal income tax withheld, across a look-back period. Under $50,000 in annual liability puts you on monthly deposits, which is where most solo S-Corp owners with reasonable salaries in the $30,000 to $70,000 range land. Deposits are due by the 15th of the month following the payroll period. The payroll service tracks this automatically and handles the deposits without any monthly action required from you beyond reviewing the report. 4 payroll services explicitly support the solo S-Corp owner-employee case at the price point a single employee practice can absorb: Gusto, OnPay, QuickBooks Payroll, JustWorks. All 4 handle the federal and state filings, the W-2 generation, the new hire reporting, and the SUI mechanics. Pricing runs $40 to $80 per month for one employee, including federal and state filings. The full vendor comparison sits in Module 19.5. The operating criterion here is single. The service explicitly supports S-Corp owner-employee payroll and produces clean 941 plus W-2 generation. Anything that meets those two criteria is appropriate. The rest is preference and feature fit. The most common failure mode follows a single pattern, and the cleanup runs an order of magnitude more expensive than the setup would have. S-Corp election goes through in year 1 via Form 2553. Money moves out of the business account as distributions through the year, $5,000 in March, $8,000 in July, $12,000 at the holidays, and no payroll service ever gets configured. The accountant pulls the year-end return in February and finds the missing wages immediately. Retroactive payroll then has to reconstruct 4 quarters of 941 filings, 4 deposit cycles, and a W-2 the coach never received, with late deposit penalties stacked against the original filing dates. The prevention is 1 onboarding hour before the first January distribution. Quarterly payroll is allowable and is what most solo S-Corp owners actually run because it reduces administrative overhead without changing the underlying compliance. Some solo owners run payroll less frequently than every 2 weeks to keep the operating workload light. Quarterly payroll, 1 run per quarter, 4 payrolls per year, 1 W-2 at year end, is fine under the rules as long as the deposit schedule still gets met by the 15th of the month following each payroll period. The payroll service handles the deposit calendar automatically based on the payroll runs you schedule. 4 payrolls per year produces 4 941 filings, 1 W-2, and 1 Form 940. The same compliance output as biweekly payroll with materially less per cycle administrative work. A worked year through Gusto with quarterly payroll makes the structure concrete and the savings real. A coach with S-Corp election sets up Gusto in January. Quarterly payroll of $7,500, 1 quarter of a $30,000 annual reasonable salary set in Module 11.2. Year end, 1 W-2 for $30,000, 4 quarterly 941s, 1 Form 940. She also takes $60,000 in distributions across the year, separate from payroll. FICA exposure runs only on the $30,000 salary, not on the $90,000 total. The 15.3% SE tax savings on the $60,000 distribution portion is real money. Module 11's math becomes actual dollars in the bank.